Hi, I'm Emily Flippen, an investment analyst here at the Motley Fool. On today's FAQ, we're going to answer the age-old question of how we find and invest in really great companies like Apple and Amazon. Now, there is no doubt that great companies continue to provide value for investors. Over the past 5 years, the FANG stocks, that's Facebook, Apple, Amazon, Netflix, and Google, are up an average 219% versus the market's 48%. In fact, these large companies continue to drive most of the growth that investors see in the markets today. So, although these companies are now household names, they weren't always the golden child for investors. So how do you, as an average person, find great companies like Amazon early on and enjoy 500 or 1,000% returns on your money? Well, to start, you need to remember that you're buying part of a business, not just a ticker. When you're buying companies, you should be looking to make long-term decisions. You should plan to be buying a part of a business and holding it for years, preferably as long as possible, but at least 5 years. For reference, Amazon shares lost more than 90% of their value during the dot-com bubble at the turn of the century. But long-term buy and hold investors won out. So if you had bought Amazon right at this peak, right before the dot-com bubble crash, but held without selling, you'd still be up nearly 1,600% today. So when you think about buying businesses instead of tickers, that leads you to look at important factors like management and sustainable competitive advantages instead of short-term market noise. That's how you find great companies. Think about it this way. Would you ever give your money to a friend or coworker that you didn't trust? The same is true for investing. You should find leadership that's trustworthy, inspirational, and dedicated. Look for businesses with missions that you appreciate and management teams that have their compensation tied to long-term business results. That way, your incentives as an investor are aligned with yours. In Amazon's first shareholder letter, Jeff Bezos wrote, "We believe that a fundamental measure of our success will be the shareholder value that we create over the long term. This value will be a direct result of our ability to extend and solidify our current market leadership position. Because of our emphasis on the long term, we may make different decisions and weigh trade-offs differently than some other companies." Amazon's management made its position and focus very clear, and as investors, that kind of vision and transparency is precisely what you want from a company's leadership. So once you've found a company with management that you like, you then have to evaluate their business. Here at The Fool, we look for a variety of things, but the big one is businesses that are benefiting from long-term, undeniable trends. So when you think about the business, do you see it being bigger and more relevant 5 years from now versus today? If the answer to that isn't a resounding yes, then you probably shouldn't be investing in the company. For example, Amazon has grown to a near $1 trillion valuation thanks to several huge trends. It's benefited from the rise of e-commerce and cloud computing. Investors that recognize those trends and Amazon's growing market leadership in the retail space, as well as the strength of its web services businesses, quickly realize there is still plenty of growth ahead for the company. Additionally, we look for companies with a strong and solid financial position that will allow them to continue to finance their operations far into the future. We look for businesses that have reasonable levels of debt, strong operating cash flows, and high returns on invested capital. These are the things that enable companies to continue to run their businesses, which is vital for shareholder returns. Lastly, it's so important to invest in a company that has a special edge. Now, this is a really hard thing to quantify. In fact, with most great companies, you can't find a competitive moat in numbers alone. But what you should always know is what makes that company stand out from its competitors. What does this company do differently that prevents anyone else from taking over? In Apple's case, it's the company's brand, its incredibly sticky ecosystem that spans all of its devices. The company has engineered products that people love, and once someone buys an iDevice, they actually tend to be an Apple customer for life. Now, as you can probably tell, we're looking for best-in-class companies, and those kinds of businesses rarely look cheap. A great company will always usually have a premium attached to it, which is why we rarely let valuation alone prevent us from getting in early on a great company. We hope this helps you get started on your investing journey, and as always, thank you so much for watching. If you have any thoughts about how you go about finding great companies, please drop them in the comment section below. And if you have an idea for another video, do let us know. If you're looking for more info on investing, check out our investing starter kit at fool.com/start. It covers everything from saving money to buying your first stock, and it even comes with a 5-stock sampler to get you started. If you enjoyed this video, give us a thumbs up and be sure to subscribe to get more content like this from The Motley Fool.